Hope you all can hear me loud and clear, and also you can see the screen that I'm sharing with you. As usual, if you do not have any questions, we can actually move into the discussion that we were continuing. If not, please, if you wanted to clarify anything, you can raise it. If not, you can put that in the chat mode also. So we can clarify any details as we discuss the topic. But interestingly, this is the continuation of the money supply process that we were discussing. And you probably kind of have a little practice also with respect to multiple deposit creation that we discussed in our not last lecture, the week before. And in the last lecture, we more or less covered the simple model. But interestingly, we have figured it out the simple model where the money creation could have leakages, the critics. Okay. But interestingly, we also clarified the details in terms of the variables that influence the money supply. Irrespective of whether it's borrowed or non-borrowed, okay, you have a same influence of increasing money supply when you have borrowed resources increasing, non-borrowed resources increasing. And similarly, we discussed the possibilities of what happens to changes to required reserve ratio. Increase in required reserve ratio would have a decreasing influence on money supply. Similarly, excess reserves also would have a decreasing influence if you increase the excess reserves. And also, if you keep more currency in your wallets, okay, or taking out currency from your deposits, that means withdrawing from your deposits, that also would contribute to decreasing the money supply creation, right? So you see the possibilities of borrowed and non-borrowed contributing to increase the money supply, whereas keeping more currency, that means currency holdings, increasing reserve ratio, statutory reserve ratio in the case of Sri Lanka, and excess reserves would contribute to reduce the money supply process. So this all we have put it to the table and we discussed, and I believe this is where we stopped our discussion, right? So we can continue from here. And interestingly, more or less, we might finish our discussions most likely with another class. I'll try to discuss how best we can fit that session. Next week, Saturday, I don't think I will take that long to finish, and I will not be again in the country for the weekend. So we'll try to see alternative time being fixed. But anyway, continuing our discussion, you see, now we are moving to a concept called money multiplier. Money multiplier. So when you say multiplier, you can generally get a kind of a feeling that gives you a multiple expansion possibility. Yes, in the case of money also, there's a multiplier that is considered as one of the key drivers of money supply in today's context. Okay, so when you say a money multiplier, the meaning is this multiplier or the money multiplier is the amount of money, okay, amount of money that banks generate with each dollar of reserves. Okay, when the banks keep reserves with the central bank or Federal Reserve, that itself gives the ability of the bank to create certain amount of money and that creation ability is defined by this multiplier. So if somebody wants you to define this, you can simply say the multiplier is the amount of money that banks generate with each dollar of resource. Reserves is, that is the amount of deposit that the central bank requires bank to hold and not lend. Each deposits that you receive, as let's say you are a banker, you receive $100 of deposits, 100 rupees of deposits. Of this deposit, you have to keep a certain percentage that is defined as the reserves. Mostly statutory reserve is the amount that you have to keep with the bank. In the case of Sri Lanka, it is now 4%. It was 2%, but on 18th of August, Central Bank announced to increase the statutory reserve requirement by 2 additional percentages to 4%, effective 1st of September this year. Okay, so since 1st of September 2021, the required reserve ratio in Sri Lanka is 4%. So every 100 rupees deposits the banks get, the 4 rupees you have to keep with the central bank. Okay, so that's the required reserves, or the reserves in a general sense. The central bank requires bankers to hold. So the multiplier is the amount of money that banks can generate with each dollar of reserves that you keep. Then you can go on to define the banking reserves is the ratio of reserves to the total amount of deposits. So when you look at this banking reserves, often it may be slightly higher than the required reserves. You can define this by looking at the absolute volume of reserves that you keep with the central bank and look at the total deposit base of the bank. And if you divide it and see, often maybe it is slightly more than what is required. Let's say more than 4% in the case of Sri Lanka, most of the banks maintain. Why? Apart from the required reserves, they also keep a little excess reserves. Not big, but little. Right? There may be times where banks would be running short of reserves, then they quickly refinance through other sources and make sure that they keep the required reserves in the central bank. So to understand the concept, please take note what is multiplier. Now you know that. You already know about the reserves, and then you can define further the banking reserves. That is the ratio of resource to the total amount of deposits. You have 100,000 as deposits, but you have 1 million as a deposit base. So 100,000 over 1 million is the deposit ratio, banking reserve ratio, sorry. That is banking reserve ratio. You have 100,000 as the reserves, 1 million as the deposits. So just an example, right? So you have to make sure that you are maintaining the required reserves in line with the central bank's guidance. If not, you have to bring new money. If you have more reserves in the central bank, that means you are keeping more excess reserves. Then you can pull it out at your discretion. Okay. So then to further move on and elaborate few details, you know what is monetary base and things. Why we have defined monetary base very clearly as C plus R. Currency in circulation plus reserves. That is monetary base. Okay. But now we are just moving ahead. Please now note, okay, money. We take M1 here because I was mentioning as we move on with the defining this different money supply considerations, we take different M's. higher the M affiliation, let's say M2B, M3, M4, you are bringing additional components of money, but with less liquidity. M0 is most liquid. M1 is most liquid plus the next level of liquid. Likewise, you add on, right? You had that table we discussed in one of our lectures, you add on. So now you define M1 as the currency plus checkable deposits. Checkable deposits is deposits that you can withdraw at any time. No fixed deposits. Fixed deposit has some conditions. You have to fulfill certain conditions in terms of withdrawing fixed deposits. Maybe if you withdraw before the time defined for fixed deposit, you might lose the interest, or you have to pay a penalty to the bank. There are certain conditions, but checkable deposits is not the case. That's been defined. If there's any consideration, you can withdraw based on your discretion. So C plus D, if not CD, is the M1, currency plus checkable deposits, right? So then we define here in terms of money supply and monetary base and multiplier. And remember, we define multiplier as simple M. So nothing but the money supply being then is the monetary base time the multiplier. So you can now write down the equation, the money supply equals small m, that is multiplier times monetary base. You know what is monetary base? C plus R. Right? So C plus R, already you know, we went through that in the simple model, and even in the big model, there's no difference. But for our further understanding of this concept, we have now brought in money multiplier into the equation. So we defined money supply M as multiplier times monetary base. While this being said, we also try to define M1 as currency plus checkable deposits. Okay, so we just leave it at this point and we move on to discuss this multiplier with little more details for your understanding. Right. So I'm just continuing. Any questions that you have with respect to what we were discussing? Or even you can put them down and share with me so I can clarify while I'm discussing. Then, of course, this multiplier, we derive this multiplier. We will get into the details in terms of identifying here, okay, this holdings of currency. People hold currency, right? You might have your bank account, you have your general salaries being deposited, or whenever you receive a loan, the banks would credit the loan into the deposit account, but you withdraw certain amounts based on your requirements. So that is the desired holdings of currency. Okay. So what we have to take here is desired holdings of currency, that is C, and excess reserves that you probably kept with the central bank over and above your required reserves. Any amount over and above the required reserves is excess reserves. So we have to take a rational view here. This holdings of currency and excess reserve amounts also grow proportionally with checkable deposits. That means when the checkable deposits increases, you probably see in absolute value, the holdings of currency and excess reserves also increase. from 100,000 to 1 million, yes, there's an increase in currency holdings, that's for sure. If you see 100,000 rupees is the checkable deposits now, people might be holding, let's say, 10,000 in currency. And you require about 4% being kept with the central bank, that means 4,000, but you are keeping 5,000. Right? So this 100,000 increased to 1 million. Now you hold 100,000 in currency, 50,000 in excess reserves. 4% is of 1 million is 40,000, right? So additionally, you have some excess reserves. So this is what I'm trying to say. With the checkable deposit increases, proportionally, the other two variables that we are discussing also increases. Maybe as a ratio, it might decrease because more and more the deposit base increases. You do not need the same amount of currency to be held. But in absolute value, yes, it's increasing. Excess reserves also, you don't need to have that additional 1,000, 10,000, that same proportion being increased. No, might be slightly at a decreasing pace, but you are increasing the absolute value. Okay, so that's a kind of rational expectations being brought into the equation. So then you see, you already know about these ratios. Small c is the currency ratio. You already discussed the currency over deposits. Like I was mentioning, 10,000 over 100,000 deposits. So 10,000 over 100,000 is the small c currency ratio. If you take 10,000 over 100,000, it is 10%. Then similarly, you know excess reserve ratio. It is excess reserves over deposits. We were talking about 4%, and I said 5,000 when it was 100,000 deposits. So 5,000 over deposit is the reserve ratio, right? So if you take out the required reserves from that reserves, that is 4% for 100,000 is 4,000. But I said 5,000 you are keeping as reserves. So excess reserves is 1,000. So 1,000 over 100,000 is 0.01. That is 1,000. Okay, it's a 1% excess reserve ratio in this exercise. Right? So when you paste percentages expressed in decimal places, 0.1 is 10%, 0.01 is 1%. Okay, you do define these things and divide and see, will you? So that's how the ratios would come. So now you are very clear in terms of what is currency ratio, what is excess reserve ratio. These are nothing new. You express the currency as a share of the deposits, excess reserves as a share of deposits. So that's why we say these as ratios. And for easy understanding, small letters of these two being considered as ratio, normal big letters are the particular variable. Currency, big C. Currency ratio, small c. Excess reserves, big ER. Okay. Small e is excess reserve ratio. D is deposit base, checkable deposit in this case, right? So we are just getting into the multiplier being defined or deriving the multiplier. You know what multiplier is already. So we are trying to get into these details and try to expand it to understand more clearly. Right. So you see now this multiplier, and you already know the reserves maintained by the banks often And almost always, I can't completely say always, but almost always, the banks keep reserves in the form of required reserves and excess reserves. The amounts that they have to keep with the central bank is the required reserves. But banks keep something more than that. So to define it now, that is the combination of required plus excess, required reserves plus excess. So we now define the reserves as required reserves plus excess reserves, that is RR plus ER. That is this component in the handout and the equation. R reserves equals required reserves plus excess reserves. Okay. So the total amount of required reserves equals the, at any given point of time, from your deposits, the required reserve ratio. So you wanted to find out what is your required reserves at any given point of time. You already know what is the required reserve ratio, because central banks don't change this required reserve ratio every day or every hour. It is usually once announced, stays for longer period, maybe years. They don't change next year just because changes happens. No, they change it rarely after a long time periods for markets or the financial intermediaries to settle with the prevailing required resource circumstance, and maybe changing with advance announcement. For instance, I said 18th of August, central bank announced that they will be increasing the required reserve ratio from 2% to 4%, and given the banks the 2 weeks time to adjust. Implementation date was 1st September. And that change also happened almost after about 5-6 years. Prior to that, 2% was announced somewhere in 2015, if I'm not mistaken. Right? So what you are basically seeing here is this required reserve ratio, once defined, it is reasonably static, not change every other day. So you have this ratio 2%, and you know what is your deposit, checkable deposit base, that is D, capital D, right? Required reserve ratio is small r times deposit base would define what is your required reserves, right? So it's here. At any given moment of time, you can figure it out what's your required reserves if you know the required reserve ratio and the deposit base. Checkable deposits for easy understanding here. So you see RR equals small r, this is ratio, required reserve ratio times the deposits. So you know in the first equation, we have defined reserves as required reserves plus excess reserves. Now you know required reserves as small r times D. So now for required reserve, we will replace in the total reserve equation this component, small r time deposits. We will replace required reserves in the total reserve equation and write down the total reserve equation as R, that is total reserves, equal small r, that is ratio time deposits, plus ER, that is excess reserves. So this is again nothing but total reserves is equals required reserves plus excess reserves. Okay. And please understand, no central bank in the world would set this small r as 1. Why? If you set this as 1, that means the entire deposits you have to keep in reserves. So that means required reserves is always equal to the deposits. Then banks would not have any money to do any other activity except other forms of raising finances. So no central bank in the world will do that. They would actually define a required reserve ratio closer to 0. Not closer to 1, but closer to 0. Mostly small single digit. That means more towards 5 or less. There may be circumstances, could be 10%, that's possible, but generally more towards 0 side. Okay, so now you know you have defined the total reserves as required reserves plus excess reserves, and then you define required reserves as required reserve ratio times deposits, and replace that required reserves in the total reserve equation with that expanded equation. So you know reserves, total reserves as reserve ratio small r times deposits plus excess reserves. Clear? Right. So we can move on. Any questions? Okay. So you simply see here the money multiplier. We are now expanding. You already know the monetary base. We were repeatedly signaling this monetary base with our discussion to say that C plus R. You know what is R there, what is C there, right? And you just define R in the previous slide. It's here. It's here. This is R. Here you just define, right? So that R being expanded within the monetary base equation. C plus, instead of R reserves, you define that as required reserves plus excess reserves. And required reserves you have further expanded to say required reserves is required reserve ratio, that is small r times the deposits, checkable deposits for this particular example. So it's more straightforward now to say monetary base as C plus required reserve ratio times deposits plus excess reserves. This is nothing but this R component, reserves component, being expanded to say like this. Okay. So the equation that you see now, it reveals the amount of the monetary base. Okay. The amount of the monetary base, monetary base C plus R, needed to support the existing amount of checkable deposits, currency, and excess reserves. D, C, and ER. Checkable deposits is D. Here, big D. Currency is C. It's here. Excess reserves is here. So, to support this combination, what's the monetary base required? So, we are now getting into the inside of this monetary base by expanding from our conventional C plus R definition to more detail what is inside this C plus R. And we have now defined within R, you have nothing but required reserves and excess reserves. And then within required reserves, we simply expanded to say that the required reserves is nothing but required reserve ratio times the deposits. So this monetary base, what you are seeing here, that reveals or explains to you the amount of monetary base that requires to support currency, the deposits, and excess reserves in an economy at any given moment of time. The central bankers often look at these variables for different analytical purposes and also for their monetary policy decision-making process. Right. So we will move on to further elaborate this equation in terms of deriving the money multiplier. Okay. So here, small c, you already know, small c is currency ratio, right? So currency ratio is easily identified by currency over deposits, C over D. Small c is currency ratio. So you can rewrite the same in terms of currency. Let's say you take this component, this C, being represented as the main variable, then you can simply take, this is division, below the line D would go to the other side as a multiplier. So it is simply currency held is nothing but the currency ratio times the deposits. Currency ratio is nothing but currency over deposits, C over D. So amount of money you hold in your hand is a ratio, that is small c, from your deposit base. So the currency ratio is very straightforward, C over D, and at any given moment of time, the currency ratio time deposit base would tell you what is the currency that being held. Similarly, we know this small e, that is excess reserves. And at any given time, excess reserves amount, 1,000, we were defining in our 100,000 deposit example. 1,000 over 100,000. Excess reserve amount is 1,000. Deposit we were talking about was 100,000. So if you put 1,000 over 100,000, you will define what is the ratio. That is small e. So if you put 100,000 here, that is excess reserves, you know what is the base, deposit base, 100,000 here. You can figure it out what is the small e is. Or if you know the small e and you know the deposit base D, small e times D would define the excess reserves. So you are expanding the currency ratio, you are expanding the excess reserve ratio. These are nothing new, even under the simple model we discussed. Okay. So you already know monetary base C plus R. Okay. So in the last slide, we expanded C plus R. We maintained the C. We expanded the R into required reserves plus excess reserves. Required reserves, we said, it is small r, required reserve ratio times deposits. Okay. So now what you are trying to do is, you are trying to expand again the C and excess reserves ER in the equation you just derived in the previous slide. This is the equation. C we didn't expand it. ER, excess reserves, we didn't expand here. Only the required reserves, RR, been expanded to say required reserve ratio time deposits. So this component, this R times D plus ER, is nothing but R reserves. So we are now going here to expand it to say that we are now looking at both C and R in its detail components embedded. What is inside these C plus and C and R. So you know R. So monetary base C plus R. You know R. R comprised of required reserves, that is this required reserve ratio times deposits, and excess reserves, that is nothing but excess reserves ratio times deposits. That's why we here explain excess reserves. So now we have defined the R within the equation. We have expanded the R in terms of required reserve ratio and excess reserve ratio. To show that, we need to know what is the deposits, that is D. Small r times D is required reserves. Small e times D is excess reserves. Then currency, C. You know currency is here. It is nothing but small c times deposits. Small c is what? Currency ratio. How much you hold in currency form. You don't keep all the currencies you held in your accounts in your hand, in your wallets. No. Only a share of that. That is the ratio. So you expanded to say here, C is nothing but currency ratio times deposits. So you can see the entire monetary base be now expanded in terms of ratios representing variables within the monetary base. The variables represented within the monetary base is required reserves, excess reserves, and currency. So you can derive these by looking at the respective ratios. In the case of required reserves, it is required reserve ratio times deposits. In the case of excess reserves, it is small e excess reserves time excess reserve ratio times, that is small e, deposits. And in the case of currency ratio, that is small c times d. So all these variables expand the C plus R within the monetary base that we are studying. So you see in this component, there's a common variable that is D. So these are simple arithmetics that you are very familiar with. You take out D, what is left with you is R, E, and C. Small r, small e, and small c. What is that? Required reserve ratio, excess reserve ratio, and currency ratio. All are expressed as a share of deposits. So the monetary base, now you can rewrite, equals this. Small r plus small e plus e altogether times d. So the monetary base comprised of excess reserves, required reserves, and currency. So we are looking at these in terms of defining respective ratios. So the excess reserve ratio plus required reserve ratio plus currency ratio times deposits would define what is the monetary base is. So you divide both sides by the term in parenthesis, that is R plus E plus C, small r, small e, small c. You would define, if you divide this side by small r plus small e plus small c, this cancels off. So what is left here is only D, that is here. If you divide monetary base by small r, small e, and small c, 1 over, that will retain. So you are rewriting the entire equation here as this. So 1 over small r plus small e plus small c times monetary base would tell you the deposits of the economy at given point of time. Okay, so I have now come to the point where I defined this at the very beginning of explaining money multiplier. You see it's here. We define money as currency plus checkable deposits when we start discussing the money multiplier. That is important. That's why I just defined there and kept it, because we would revisit that equation. So we come to the point here to say deposits plus currency as money supply in this case. It's what generally we take for money supply. So you already know this component. This is currency ratio, time deposits is the currency. So you are now trying to expand this C with this component. Okay. So C times D, small c, ratio times the deposits would define what is the currency held in people's hand, currency holdings. So deposits plus currency holdings is money supply. So money supply is deposits plus, here we expand, the currency holdings, nothing but currency ratio times deposits. Okay, so here also there's a common variable. So often in simplification and deriving equations, you take out the common variable out. So you take out the common variable out, you left with 1 plus C times deposits. C is currency ratio. So money supply is now defined as checkable deposits plus currency held with people. So we expand it and derive the equation to say money supply is 1 plus C times the deposit. C is currency ratio. Then you know what is this D? D. We derived, here is D is here. You derive this D. So you replace this component to this D. Here, what you get here is nothing but 1 plus C over C is small c, okay, ratio, currency ratio over required reserve ratio, excess reserve ratio, the currency ratio time monetary base. And you already know the monetary base times multiplier, small m, equals money supply, we defined at the very beginning of this discussion. Here it is. Money supply is nothing but small m, money multiplier, times monetary base. So you know what this small m now. We discussed all this time to find out what is this small multiplier, small m, that is money multiplier. And now you know what it is. We have got into those details and we have defined and derived the multiplier. So money supply is 1 plus C, 1 plus currency ratio over required reserve ratio plus excess reserve ratio plus currency ratio times monetary base. Right? So this component that you are seeing here is nothing but small m. That is money multiplier. So you now know this small m, money multiplier, is 1 plus C over small r plus small e plus small c. 1 plus C is 1 plus small c. Huh? So you now clear to the extent where you know the money supply and you know what is multiplier, what is inside it, how you come out and derive it, and what is this component m, small m, to define what's the amount of money a monetary base would create and maintain at any given moment of time, because these small c, small r, small e's changes all the time based on people's behavior, expectations, economic circumstances. So these things changes. During pandemic period, people are holding more currency in the form of currency itself, not in the banks. Currency held by people increased during festival times, right? Sinhala Tamil New Year period, Christmas period, more currency in circulation. People want more money in their hands, not in their accounts. So the small c increases. So what happened here is when the small c increases, that would increase the numerator. Also increases the denominator, numerator and denominator. But effectively, when the currency in circulation increase, the weight created by this increase is heavier, and as a result, multiplier reduces. Multiplier reduces. So from the given monetary base, the money supply available for economy reduces when more currency held by people. Think, within this you think now. You have learned all these weeks how these variables would influence. So you now look at the small m, multiplier times monetary base would define money supply. So if this m increases with a given quantity of monetary base, you have more money in the economy. If this m decreases, less money in the economy. So what influences this m to behave differently? That is what we are trying to learn. So you see the C, I said during pandemic times, when people become precautionary, keep more money in the hands, right? Festival times, they keep more money in the hands. These things would drive the multiplier to reduce. When you see this E, excess resource, banks become extra cautious. They give more in excess form. The ability to create multiple deposits reduces. You already know that. You already know when more money being kept in currency form by the depositors, multiple deposit creation reduces. If central bank increases the reserve ratio, the amount of money available for banks to do multiple deposit creation reduces. But any decrease in R and small e, small r and small e would definitely push the M to increase. Any decrease in C would also, but not to the extent of these two. Because small c has a component here too. Reduction in here would have a reduction here too. So we'll do this with the inclusion. That is an example for you to understand it more clearly. Any questions before I move on? Right. So you see here, the money multiplier, we are trying to get into a intuitive example to elaborate, discuss the equation and what we derived there. So required reserve ratio, small r, is 0.1. That is 10% in percentage form. I said usually the central banks would love to keep this required reserve ratio closer to zero, small single digits. But in this case, it is a 10%. It's a high number. Fine. For us to easily understand, let's take it. Required reserve ratio is 0.1, 0.1. You know, currency in circulation is $400 billion. That is C, not small c. This is not ratio, but you know, it is C, currency in circulation. So you also have checkable deposits. That is D. That is $800 billion. So from this 400 and this 800, C and D, you can easily derive small c. You have learned that. C over D, 400 over 800 is small c. You learned that. Then you have excess reserve ratio. But here they have given not small e, but they have given absolute value of excess reserves, ER. That is $0.8 billion. So if you wanted to derive small e, what you had to do is $0.8 billion over deposit base. 800 billion, you can derive small e. And they also given you the money supply. That is, you don't need to worry about that because money supply is what? C plus D. We defined it. You remember? M1. Currency plus checkable deposits. So 400 currency, 800 is the checkable deposits. If you add these two, $1,200 billion. That is $1.2 trillion. A trillion is $1,000 billion. Okay. So you see here, from the information that you have, you can quickly derive what is the small c. Small c is nothing but currency in circulation 400 billion over checkable deposits, that is 800. So 400 over 800 is 0.5. 50% of deposits are held by people in currency holdings. It's a very high. From a general perspective, half of the deposits are held in currency form is a high amount of currency held in hands by people. Okay. So then you see small e, excess reserve ratio. So the currency ratio is 0.5. Excess reserve ratio is nothing but excess reserves over deposits. Excess reserves here is 0.8 billion over deposits 800 billion. This is nothing but 0.001. 1% of 800 is 8 billion. 10% of 800 is 80 billion. Right? So these are simple calculations. I'm just giving you a feel. 1% of 800 is 8, but this is only 0.8, 1/10 of a percentage point. I repeatedly said, usually the excess reserves kept by banks are very small. Has to be. Otherwise, they are keeping money idle. They have to maintain required reserves. Over and above, you keep anything with respect to reserves is excess. So you now derive so-called excess reserve ratio, that is 0.001. So you know multiplier is 1 plus c. You already derived 1 plus small c, that is 0.5. So 1 plus C, small c, 1 plus C is 0.05. It is 1.5 if you aggregate it. The denominator is what is that? Small r, required reserve ratio. Already given 0.1. We don't need to calculate, but if you require to calculate, you have to calculate it. In absolute value, if they simply said here, required resource is $80 billion. So you have deposit base, then you can calculate the ratio. Okay. So here they have given, we have just brought in and plug it to the equation, 0.1 plus excess reserve ratio, small e, that we derived 0.001 plus small c, that is currency ratio 0.5. So adding this all together, it is 0.601. So 1.5 over 0.605, double of 0.601 is 1.202. Balance is about 0.3. So 0.6 is half of that. So you see 1.5 divided by 0.061 is nothing but 2.5 times. So multiplier is 2.5. So if you have a monetary base in this economy, let's say 1,000 billion, that is 1 trillion, but it has to be more than that given this example. You see, given the details, but for example, let's say 1,000 billion, right? So money supply is small m multiplier times monetary base. 1,000 is the monetary base, multipliers 2.5. So what's the money supply there is 2.5 trillion or 2,500 billion. In this number, small m being a factor to $1 billion, $1,000 billion monetary base. So this answer that you have seen here, multiplier is smaller than deposit multiplier or the simple model that you have learned previously. Right? Why that's the case? You see in the simple model, we simply assume there is no excess reserves. They basically go on and expand the money supply and there is no withdrawals by depositors. So it is perfect from a scenario in paper, but in reality, you see banks keep excess reserves, people withdraw and hold deposits in currency form. So that breaks down the monetary expansion possibility of a deposit base. So that's why here you have seen 2.5 times, whereas in our simple model, it is 10 times. Okay, so to say that deposit could have multiple expansion possibilities, there is no such expansion when you hold the deposits in currency form. So currency does not have expansion. You take it out with hold in your hand, that's it. Money supply is 1-to-1 then. But if you are holding that in deposit form, after leaving required reserves, the banks could expand that in multiple form. So that's the reflection here in terms of the lower money multiplier being derived in the detailed, complex model compared to straightforward, simple model that you learn. Now you adjust this small c, small e, small r, and see what's the influence that have on the multiplier. As I said, if you increase the small c, numerator also increases, denominator also increases. Okay, so you can increase this 0.5 to 0.6, and here also this will go up. Then this will become 1.6. If you change this 0.5, that is currency ratio 1 plus c from 0.5 to 0.6, this numerator will become 1.6. So as a result, denominator also here it is 0.6. So this become 0.701. So 1.6 over 0.701. This is not 2.5. This would be lower than 2.5. It would be something like 2.3. Calculate and see. So increasing currency holdings would reduce the multiplier. I said before, you can experiment and see. You can change this required reserve ratio and excess reserve ratio. Let's say we change this required reserve ratio to 0.05, not 10%, but 5%. So this become 0.05. So this denominator would tally then to not 601, but 0.551. So then this 1.5 over 0.551 would give you a 2.8 like multiplier. You can calculate and see. So more money supply can be created with reduction in reserve ratio, required reserve ratio. So do some experiments and see what influence this would bring. So to say that when there's a policies introduced by the central banks, what happens through those policies can be, now you can ascertain, you can at least foresee what's the influence to overall money supply. So when the money supply changes, what happens to the interest rates, what happens to the exchange rate, you can go on and define. So that's why we are trying to learn these things. What is underneath these equations, how this been influenced, how this been influenced to the policy variables. And that's the inclusion of this entire exercise that we discussed. Any questions before I further move on and explain? Okay. So we can move on. Right. So we will talk about some application now. So you had this Great Depression we discussed with financial crisis. Prior to that, the Great Depression and bank panics in 1930-33 period, and what happened to the money supply during that period. Okay, so bank failures during that 1930 period, there was no significant deposit insurance structures. Bank failures during that period was influenced by depositors' behavior, where people started taking out their deposits. They didn't trust the banks at that point of time. So we discussed to the extent where we were talking about financial disintermediation. People were not confident about the banking sector because there was no deposit insurance at that time. So people started seeing deposits were pulled out and held in currency form. So depositors' behavior. So immediately, this would have contributed to increase the small c in the equation from depositors' behavior. So as a result, increasing small c would pull down the money multiplier, small m. You have already seen that. We were explaining when small c increases, what happens. Then from a bank's perspective, they also started keeping more in excess reserve forms over and above required reserves. That means small e increase because banks were expecting people would come to withdraw. So whatever the amounts that they have kept in excess reserves when people come to give. Otherwise, if they lend it, they have to go behind those assets and try to cash it. Okay, so small e also increase. So what happened there is increasing small e would increase the denominator below the line of the equation, right? So you see that also reduces the small m multiplier. So bank failures during Great Depression reduces because of depositors' action as well as bankers' actions to reduce the money supply. During this period, the monetary base was reasonably constant. Monetary base C plus R, that was reasonably constant. Or there were no policy intervention to change the monetary base significantly during this period. But due to money multiplier decreasing, money supply declined during this period. You can see that here. Failed commercial banks during that period, where the deposits of these banks, millions of dollars, because those periods, the billions were very big, so millions of dollars. Let's see, the bank failures were, and the deposits of failed banks during that period, see, it's increasing. Still prevalent, but generally again decreasing after latter part of 1931, right? So you can again reflect here what happened to excess reserves and currency ratios. Excess reserve ratio, small e, is the black line, and the y-axis is right-hand side. This is the excess reserve ratio here, and this is the variable value. So excess reserve, as I was repeatedly and all throughout explaining to you all, were usually kept at very low levels. Very low levels. Closer to zero. But you find these excess reserves significantly increasing during the Great Depression period to almost 5% levels by mid-1933. Banks are, that means keeping more funds in excess reserve form in the central bank without making use of those funds for their business purposes. Because banks also become precautionary. because all this money they are keeping with the central bank over and above their required reserves are not generating any income for them. So while they are just keeping there, they become risk averse. These banks also become risk averse. They were worried about economic activities, how quickly these economic activities expand, and so forth. Right? So again, the start of banking crisis also contributed to some extent because people are coming to banks to withdraw their money. So banks also require to keep some form of liquidity, so probably they also kept it. But you see the excess reserve ratio increasing continuously. So that means the small m denominator side is increasing. So that means that m would reduce. As a result, money supply would reduce. We also see a similar tendency in currency ratio, that is here, the blue line. And the left hand axis, y-axis, to show you the values. Generally, the currency held in US is about 17 to 18% of total deposit base under normal circumstances. Less than 1/5. But this small c, see here, with the crisis, Great Depression increasing, it's almost hit 40%. 40% of deposits were held in currency form by 1933. People become increasingly cautious, and precautionary motive has driven people to withdraw money, and they were not trustful about banks to keep their deposits also. So they were withdrawing money. So as a result, you see the amount of money held by these agencies not agencies, the people, right? People in the US has increased significantly in the currency form. So you can again look at this small c in the equation. What happens to the small c, both numerator and denominator? You have this in the equation here. Small c, 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 numerator, denominator. Numerator also increases, denominator also increases, but ultimately small m multiplier reduces. So that would contribute to decline in money supply. And this is the money supply and monetary based behavior during that period. You see, monetary base remained reasonably stable, no change. During the entire period, monetary base behaved in a reasonable level. Right? But what you are simply seeing is money supply is decreasing. What drive this money supply to decrease? Given a certain monetary base, the money supply m equals small m times monetary base MB, where the MB is equal, that means the small m has declined all throughout to drive the monetary money supply to M1 to decline. That's what you are seeing here in terms of the behavior. So interestingly, if somebody asks you a question by showing a graph like this, for a given steady monetary base, what happens to the money supply in this instance? You should be able to explain now. They would also try to ask from you, what would have been the reasons for a money supply behavior reflective or depicted in the chart above? They will ask this type of questions to check your application. The precise answers for that is again explained here. This is also you can explain, but more than that, this is more than enough for you to explain that in terms of why money supply is decreasing for a given state of monetary base during this period, in the case of the example reflective here. So that's the Great Depression. Now look at the application for a recent financial crisis. And I believe we'll be able to see by next year or the year after, we will also try to discuss about the pandemic period behavior, the COVID pandemic period behavior. Still, it's too early for us to bring in all the numbers and show, but we'll be able to. So you are seeing here the financial crisis and the money supply of 2007-2009. Subprime mortgage market driven financial crisis. We were talking about this. Right? So during this recent financial crisis, the very, very interesting aspect is the monetary base tripled. Monetary base expanded very fast. And there is no difference during pandemic period also. The monetary base expanded by manyfold as a result of policy-driven money supply expansions all across the world. So you probably see the monetary base is increasing continuously during this period. Okay. So then you see during this 2007-9 financial crisis period, the currency ratio not increasing like, the Great Depression 1930 period problem. People are not necessarily withdrawing their money from the deposits. Why is that? Why they were not taking too much and they are not taking a precautionary behavior? During this period, particularly across advanced OECD and US and even in Sri Lanka to some extent, we have so-called deposit insurance facilities. In US, it's very relevant. So people are not panicking to withdraw their money from banks because they know if the banks fail, they have the deposit insurance. But effectively, during this financial crisis period, currency ratio, small c, has decreased, not increased. And that has to, decreasing small c has to contribute to increase the small a multiplier in the equation. And as a result, money supply has to increase. But interestingly, what happened during this 2007-9 period is, despite the monetary base was expanding, despite the currency ratio is decreasing, the banks were increasingly started to become risk averse. Banks were not sure where the economy's direction and whether the economy's other agents, economic agents, were sound enough in their financial books. Although receipts, they were worried about the possible asset qualities they held in their portfolio. So they are not necessarily lending, but increasing the excess reserves. So small e, excess reserve ratio was expanding during the financial crisis, recent financial crisis. Okay, give me a second quickly. Excuse me. So what I was explaining to you is during the financial crisis, the recent financial crisis, monetary base tripled. But like in usual crisis periods, this time around, people not started withdrawing their deposits, rushing to banks to pull out their deposits. No. Actually, the currency ratio has decreased, small c. But what was the behavior of banks during this period was, they become increasingly risk averse by expanding the excess reserve ratio. They were worried about the quality of other economic agents' assets in their portfolios. They were not ready to lend. They were not ready to expand their loan portfolios because they were not sure whether the assets reflective has toxic features. So they were worried. So the excess reserves have expanded, and that acted not favoring the expansion of money supply, although the policymakers did everything to expand the monetary base, through which expecting overall economic activities to recover fast. Of course, that happened, but with a lag. So we'll see that in greater details. You can see here The monetary base in black curve, money supply in blue curve. You can see from about 800, 900 levels of monetary base has gone about 2 trillion, 2100 levels. It has actually almost tripled, increased substantively during the crisis period. But money supply not increased, marginally increased, but not by the amount of expansion in monetary base. So the monetary base was much bigger than the money supply during the recent financial crisis. This could be explained by looking at currency ratio and excess reserve ratio. And you can see here the excess reserves. This is the excess amounts held by the banks with the central bank. It is actually going well above, from almost zero levels to almost 100%. Because everything that additionally pumped in as monetary base and given to banks to engage in economic activities have not been used for economic activities as envisaged by policymakers, but kept in the central bank itself as reserves. Because they are worried, banks were worried whether their lending would contribute. And people also not withdrawing their monies. Because one is deposit insurance. The currency ratio has actually declined during this period. They were actually looking at the deposit insurance schemes and also assurance from the central banks and the governments that the money with the financial regulators and the deposit agencies would be guaranteed. Even in Sri Lanka, at different points, there were assurances that the deposits maintained with certain financial intermediaries being guaranteed by the government. So you can see this behavior: reserves, excess reserves, and currency ratios, and also the lending monetary base expansion during this period to the financial intermediaries and other economic agents were almost at zero cost. There was no cost for those finances expanded by the policy authorities. So these agencies didn't feel, even if they don't make use of them and keep it in the excess reserve form in the central bank, they're not losing anything. So that these are the changes in policy making, policy thinking, application from 1930s to recent 2007-9 financial crisis period. This is very interesting and very important for you to understand, right? So these two slides are nothing but same explanation I was explaining to you previously. And this is same change in deposit and change in reserves for you to, if you wanted to read it through. So I will not explain this equation. This is the same multiplier equations explained for your reading, that you can read it. But please go through again and again of the discussion in terms of deriving the multiplier and then its application. It's very, very important. You should be able to differentiate the recent financial crisis period against the previous financial difficulties that the world has gone through, right? And I'm not going to take more time today simply because I really want you all to concentrate at least about another 15 to 20 minutes of what we discussed, what we applied in application, to be repeated and try to understand with the money multiplier equation itself to explain why the money supply has behaved differently, why money supply has not behaved, monetary base expansion, why it has not helped to increase the money supply, what happened to small c, what happens to small e, right? What happens to required reserve ratios, and try to understand this clearly for you to make sure that you got the message what we were discussing, because you need that intuition now. And if you have followed my classes all throughout, you will be having this greater kind of understanding. This being said, we actually want another one class. So I was just checking, the possibility. If it is tomorrow, Sunday, is there a possibility for you all a preferred time slot, like, let's say, morning hours 7 to 9 itself? Is it possible to concentrate? Or if some others have other classes, we could think about, I believe Wednesday is a holiday, isn't it? 3rd next week. Morning 7 to 9, like. So I will check with IBSL also and try to kind of, inform you all. And most likely with that lecture, we will conclude our sessions for this semester. Right? So that is basically about monetary policy tools. But we discussed as money supply, money central banking, and they use open market operations, discount window, statutory reserve ratio. These are policy tools, right? Conventional, non-conventional monetary policy tools. That's another very important section. We will discuss that and most likely finish our semester's work, and then you can concentrate on preparing for the examination. So that being said, if there are no further clarification questions that you have, I will leave the discussion at this point and leave you all to concentrate about 15-20 minutes on what we discussed today, because that is very important in terms of application. Thank you and stay safe.